Our next session of today is going to be about the impact of the tech giant's arrival to the insurance industry. And this panel is going to be moderated by Amargan Ahmed of the Admiral Group. Have a great discussion.
Yeah. Hi, so my name is Amargan. I'm with the Admiral Group. I do business development for the group. I'm based out in Cardiff. As part of my role, I look at new products and do consulting projects across the company. So,
my name is Charles Delahorie. I'm part of the innovation division of AXA Group. We're a small team of top gunners focused on platform economy. We have the strong conviction that these global communities are becoming the new definition of geographies. They are reshaping the way people experience, sometimes purchase insurance protections. And as much as you guys are spending your time with creating Ubers, Airbnbs along the years, etc., we want to be there to protect you on your everyday cover needs.
Well, I'm Robin. I have two hats. My first hat is that I lead the digital product development at a private bank, so influence, and other digital services. And my other one, which is there, is digital scouting. It's a platform and a blog for entrepreneurs, thought leaders, and senior managers to share their ideas and best practices in tech and technology and the trends and things like that. So yeah, if you don't know it, check it out.
Cool. I'm Russell from Uber. I look after the insurance needs of Uber across Europe, Middle East, and Africa. I've only been at Uber 10 months. I came here from Zurich Insurance, where I was the underwriting director for the commercial business and the technical director there. About 7 years at Zurich and another 7 or so years before that at Allianz. So a long time in the technical, traditional insurance industry before jumping to the far more dynamic, shall we say, world of Uber. Not quite a startup anymore. It's 16,000, 17,000 employees, but and it's also interesting to see how the insurance needs across 44 countries that I look after in Europe, Middle East, Africa are common, but quite different. And trying to find insurance partners who can solve those needs with us, whether it's building our own programs or transferring the risk to an insurance partner, is an exciting part of my new job.
My name is Alex Maffeo. I'm the founder and CEO of a company called Boost Insurance. Boost is a slightly smaller startup than Uber, based in the US, and we're focused on the back-end infrastructure of the insurance industry. Our core customers are product and distribution-focused insurtech startups. So those are out there building the next brand in the insurance industry, or those that are innovating on the product side and trying to get new products to market. We've built basically the entire back-end necessary in order for those companies to get to market quickly, prove their concepts out, test new products, fail fast, iterate if necessary. We are ourselves a licensed managing general agency in all 50 states in the US, and we are an appointed agent of the largest fronting carrier in the US called State National. A couple of weeks ago we closed a dedicated reinsurance facility led by 3 global reinsurers, one being Nephila, which is the largest ILS hedge fund in the space, and also an investor in our business, and also Markel and Renaissance Re participating in that facility as well.
thank you guys. So as you can see, a very interesting and diverse group, which I'm really happy for, because that means we'll have a set of views represented in a preponderance of legacy carriers speaking. So just to get the ball rolling, I mean, I'm sure you all are aware of this discussion around tech giants and what their arrival means for any industry is happening across the board, not just in insurance, but across industries. But to get the ball rolling, really, I want to maybe get started on what does, do you guys consider all tech giants equal, or do you think there is a difference in one player versus another entrant? So, traditionally you talk about the FANG or the GAFA, Google, Amazon, Facebook, but even stretching beyond that, is there one player that you think entering offers a better opportunity, or another player that you think might be doing better in one part of the value chain? So just to get your thoughts on each of this.
As far as I'm concerned, I feel that those big tech players are only as good as the fantastic customer experience that they are providing on their respective domain. I do not see a comparison from an insurance perspective of the various players. I think that they must, any of them who wants to enter the insurance world, must apply the same rule. Start from the customer and work backward. So if you think about players like Uber, I think that they are very well equipped to provide and to disrupt the industry of mobility/motor insurance. If you think about home sharing, that would be the home insurance. If you think about e-commerce marketplace, they will be fantastically equipped to provide aggregator, curated type of aggregator thanks to data. But I don't think that there is a one-size-fits-all, and I think that each of them should really concentrate on the user's experience that brought trust to date, and to apply the same rule to bring the same super user experience, which would be beneficiary for all the industry.
Before I answer your question, can I say something personal to Russell?
Yeah.
Please come to Germany.
We are in Munich and Berlin, but only just.
No, like really like full scale. I would love you guys to have you there. So it's really cool. So to answer your question, sorry. To answer your question, I think there are two differences between you have the tech giants in the east and the tech giants in the west. But even if you look at the tech giants in the west, you have two differences. First, you have Google, and then you have Amazon that are serious about it. And the one is an ad company, and the other company is very good at selling stuff. And if I would need to bet my money on one of both, I would say that the company that's really good at selling stuff can also sell something that you cannot smell, eat, drive, or take for a ride, as insurance.
I would agree with the Amazon analogy. For me, I think when you look at what the tech giants bring, there's a lot of commonality between them in terms of wide customer base and scale, massive data engineering teams and analytics teams, and then you start to drill down a little bit in terms of the customer segments that they're dealing with. If you think of Apple on the one hand, dealing very much about a lifestyle, about a brand and experience, that's one group where I think Apple would have an advantage in some of the newer insurance provisions, newer insurance products. So when it's more about the maintaining a certain lifestyle. So if there are issues with my music or my events I go to, that connection with the personal brand and very tailored and personalized products and services, I think Apple have an advantage from a brand and a trust point of view with that market space to jump in there as an insurer/distributor. But I think Amazon, in terms of the general marketplace with homogenized products, as soon as they can start to far more clearly identify financial service needs and integrate the payments mechanisms that they have along with the customer knowledge that they can build, Amazon and Apple for me stand out from Google, Microsoft, Facebook and the others from both the trust and also that the customer groups that they are focused on.
Right. Yeah, I'll agree. Not all tech giants are created equal at all, and honestly, consumer behavior is just changing dramatically. There's a fundamental shift in how the consumer is interacting with insurance these days. So they're not shopping around anymore. The quote comparison sites are becoming less and less popular. People are just gravitating towards buying insurance at the most natural point of sale for that exact product. I don't think people are going to go to Amazon and be like, homeowners insurance, and search a list of quotes there. So I don't think they're going to be a major player in that type of space. Google Compare, there's a reason that insurance is the most expensive ad word on Google Compare. There was a natural conflict there. So they didn't really want to mess with their, they didn't want to bite the hand that fed them, so they entered and then exited very, very quickly because they got upset. I think the new affinity channel are these new technology platforms that people are using more and more. We mentioned Uber and Airbnb. It's just a much more natural point of sale for an insurance product. On the fintech side, you see more specialty lending platforms, personal financial management tools, where people are aggregating their whole financial lives into single platforms. I think those are going to be much more likely to be the new faces of insurance.
Can I disagree slightly on the Amazon point?
Sure.
You don't see that Amazon as a natural, I don't know how many people subscribe to Amazon Prime here, but there's quite a few, I'd imagine. It's almost becomes the default for any purchase online. So I think there's a point where the reflexive behavior of, I need to buy something, this is my home insurance is coming up, let me put it onto Amazon and find that product there. That default buying behavior and the referrals and the rating systems and that infrastructure, I think that will, personally, if I was Amazon, I'd be looking at driving that financial services revenue stream.
Yeah, I think, well, let's stay with the homeowners insurance example. At least in the States, there's like an 80% retention rate on a renewal rate on a homeowners insurance policy. So your natural point of sale is when you're buying that home, and that is it. You do not want to think about it ever again. So the odds of an everyday consumer being like, oh, my homeowner's policy is coming up for renewal, I better head over to Amazon to see if I can get a better rate, are probably less likely than at that more natural point of sale. I think with an Amazon, if you look at the other side of the marketplace, really, they have millions of small merchants on their platform on the back end that are setting up these little micro retail shops. That might actually be a more addressable market for them, where you can offer, a product liability product on demand as you're selling new products on that type of platform. So I'd be less focused on that consumer brand and Amazon going out and competing with like Flo or Jake from State Farm, and really just that back end actually seems to be a more compelling offer.
Well, Alex, I don't think, if I might jump in there, I don't think that it's one or the other. I think the point you made was a natural point of sale is totally valid. But if maybe not I, but a person I know, was about to renew its private liability insurance, which was at least 1,000 years old and did not include any internet things, but just like things from decades ago. Of course, you cancel it, and then you cancel too late, of course, as always, and then you need to have one more year, and then suddenly, oh, is it March already? And then you need to get a new one, and it's of course Sunday, and your friends and the agents are not there, and the aggregators you are a big fan of. I would have loved to, this person would have loved to go to the Amazon and then just type in private liability insurance. I know, I trust them, I buy them, it's Prime, I get $5 off. That would have been awesome.
I think there's a significant amount of personal bias though with these events ourselves. I mean, I'm new to the industry. I've only spent like 9 months now in the insurance industry. I can tell you, 9 months ago, I thought about insurance as little as possible. And I think most consumers, we may shop around a little bit more, but most consumers absolutely never want to think about it at all until they actually need it. Sometimes that's too late, but I think the proactive shopping for insurance is just...
I did not say that I would have had fun with it,
Yeah.
just get it done.
Don't lie, this is like your favorite hobby too.
Just to get the ball rolling a bit, maybe pick on something that Charles said and mentioned. So if you think of the fundamental insurance proposition, it is delivering a better customer service experience. So what do you guys think the proposition, how could these tech giants, obviously their cost of acquiring customers is cheaper because they've got a much larger scale, but where else do you think they could really modify the experience for customers? Could it be around self-service? Could it be around better? So, and maybe tied to the brand issue, like insurance as an industry generally is disliked because there's the notion that they don't pay out claims or they're slow to pay them. How do you think that could change?
I think it's a brand loyalty and a brand trust issue, really, in all the financial services. So you saw after the financial crisis, banks, their NPS scores were at an all-time low, and it's just the modern consumer has just like a natural mistrust of any financial institution these days. So. If you look at something like the take-up rate of AppleCare, I mean, Apple has already disrupted at least one piece of the insurance pie, right? People buy these warranties, which have a notoriously terrible reputation among consumers as being scammy products, but they buy AppleCare at like an unprecedented rate. It's because of this brand loyalty there. So I think if you have an Uber, people trust Uber more than they do their yellow taxi in New York, at least, I can promise you that. If they're offered some sort of supplemental insurance product that may fill a gap in the coverage that's offered on your commercial policy, that may have a higher take-up rate than other products that you see traditionally trying to be sold directly to the consumer.
And I think that's where I may not fully agree on what you said before.
That's fine, here to argue.
For yearly type of insurance, I agree with you. I think that there are some, the e-commerce marketplace are very equipped to change the way and to be the best place to compare. Now I have a strong belief that platforms, most of them, are shifting society from ownership to usage. And I have a strong conviction that the same is applying now to insurance. We won't own anymore any customers, but we will see more customers using our services. So effectively you have a total dichotomy between my standard yearly insurance, which effectively can be modernized from a user experience perspective, but there is a strong role of insurance companies together with the platform to cover everyday life moments. I don't need to think about my yearly insurance when I take a Uber ride, when I am going on my Airbnb, or when I'm purchasing whatsoever in another platform. I think that it is a combined role, both from the platform and insurance company, to think for the end customer so that he gets eventually the best user experience wherever he is in his life.
I think one of the places for that user experience to be innovated, and I absolutely agree that's where tech giants vastly outperform any insurance company, but is on the payment mechanisms. If you think of most or many tech giants, they already have integrated two-way payment mechanisms. Normally the refunds don't come out till like 24 days later, but there's at least a two-way flow of payments, and it's on my app. I use EasyJet commuting to Amsterdam, and I can buy a ticket with Apple Pay with a press of a thumb. The idea that I could use the tech giants' integrated services to buy, like Charles said, to consume my insurance. So if I'm booking a ticket or buying something on Amazon, and I have a small option to add some additional protections around that event for a tournament or something, not to miss the event, like cancellation insurance or something, and it's going to cost me a few euro or a few pounds, and it's an integrated touch of a button payments mechanism. And then when the claim happens, so when there's some sort of issue that means that I missed that event, and the payment comes back instantly through that integrated payments mechanism, that's the type of user experience that will mean, will change perceptions about how the insurance industry works. You won't think about I have to submit like 7 pages of affidavits and police reports, and yes, I did actually buy this ticket, eventually some money will come back. But it's a much more real-time consumption and an experience as a user of the insurance working for you. That, I think, is one of the places where the tech industry stands out, and partnerships between tech and insurance can work well.
Agreed. I mean, the user experience in insurance is pretty terrible across the board when compared to some other technology services. You have just that instant payment of a claim, or just digital. It doesn't have to be instant. It could be 4 days later if ACH is more your speed. But we're actually in the process of building our own policy admin system and going through all this whole exercise here now. And to explain to our claims TPA that we would like to offer digital payment of claims is like speaking German in New York, and it's incredible to me that is something that's such a difficult conversation these days.
I really love user experience, and I think, of course, what is the most used button at an insurance website? It's a reset password, by the way. So think about that. But I think a really exciting point about user experience is the price. And I think that where tech companies really can beat the incumbents in their own home turf is at pricing. How? And now I switch my money now from Amazon to Google, because if one tech company is able to predict risk better than the incumbents, for example, due to big data analysis, due to the data of customers they have, they are more likely to predict what risk is good, what risk is bad, or when there is a new person applying for an insurance, and then they can say, okay, this person has a higher likelihood to have a damage, and then to offer certain premiums. What will happen if they are able to do this significantly better than insurers can do it today with their mortality tables and their claim statistics? Prices will implode for those good risks, for those people or for those organizations that represent good risks. And then you don't have a bell curve anymore where all risks are equally in the whole industry, but you have a part of the industry that picks the good risks and gives a lot of a good price to them. And on the other hand, you have the others who cannot do it, who get all the rest. And then with that cost structure of the industry that it has right now, I only say good night.
So I agree with you, Robin, definitely on the underwriting and data point. I agree. These players have massive advantage. They're better at collecting data, but also probably using that data. I'm a bit more skeptical on the claims point and whether we obviously see some insurtechs are doing the instant claims thing. But do you think that's something that's very scalable? Because obviously the tech platforms that you see are doing it they are still at loss ratios and combined ratios above 100%. So it's unproven whether, the fraud risk or all of that, you can see that. So what are your thoughts around that?
Yeah, the combined ratio is something people should ignore for startups for at least a little while. I mean, startups spend more than incumbents. It's just the way it is. So I think those numbers are slightly skewed. The customer acquisition in the early stages of the life cycle of a company are by far the highest. So on the loss side, I think a lot of these models that people are using for predictive analytics, AI, even I'll put that in serious air quotes because a lot of these aren't really truly AI-based solutions. But those models need data and they need time. And in order for them to prove their concepts out, you need at least a couple of years worth of real data in order for that machine to learn. So I think if you're looking at the instant claims payment, obviously the big gorilla in the room on that issue is fraud. How do you prevent fraud on an instant claims platform? So right now it's pretty bad. If you look at Lemonade's numbers, there's a ton of issues there. But the bet is that over time, these models that they're learning will just get smarter and smarter with more data. If that proves to be the case or not, it's still TBD, but that is the argument, that's the bet that people are making in the long run here.
I think one of the challenges is at what point does personalization of your insurance premium move away from the principle of pooling of risk. So effectively, my premium for me, it might be terrible, it might be great, so I don't share my driving habits or anything, but effectively paying the exact right premium for me each time I use my car or a mobility service might make my insurance prohibitively expensive if I'm genuinely going to be charged correctly, or push a significant amount of cost back into everybody else. As you said, at some point you say good night to the rest of the industry then, because no one wants to buy a product or a service that's impossibly expensive. But there's an interesting challenge between the idea of perfect personal pricing. So, using all of those data points to exactly know and try and predict my claims experience, at some point that becomes prohibitive or sort of breaks the insurance model. I'm not quite sure, we're nowhere near that yet, but I'm not quite sure when that boundary gets, when we achieve that. But knowing your customer well is one thing, but knowing everything about them to work out exactly the right amounts of premium they should pay, rather than spread it into an average pool, I don't think we've solved that problem yet. And claims is what will help, as you said, some data over a period will help.
But my question is, of course, we could now have the discussion about is the pool dead or not, or will it be dead? My question is more in an industry that has dependent on different parts, but has a combined ratio of 90x%, and when you have 95, you get a bonus. I mean, come on, guys! You only need a few risks, a few thousand risks, depending on the insurance line, to switch or fall out of this model, and you have a true problem. So, of course, it does not need to have the perfect model, the perfect data model, the individual pricing. That it only needs when they take out one good group.
And I think that to complement that, we here continue to see the insurance role as the role of a payer. I think that there is also a society role that insurance companies have to start to play, is to become a partner. So it's not only being a wallet to repay claims, but it's also helping the customer on his day-to-day, maybe to live better, maybe to drive better, maybe to eat better, maybe to better behave, to make sure that as well the level of claims will go down, and it's not just financially speaking, but it's also to have a positive impact on the life of the people. So moving out of, I'm just here for the bad timings, but I'm helping you to go on the right side. And eventually, I'm sure that even if the loss ratio goes down, it will be passed on to the end customer at some point. And if insurance company don't do it, I'm sure that platform will push us to do it.
Indeed. And where's the boundary there, Charles? That's an interesting question. In that, do people look at the insurance company as the risk provider and the technology giant as the partner, the personal feeling and experience of my Uber app or my iPhone? Where is the boundary between the role of an insurer? Does it sort of retreat from that front line? Or do you think the insurer moves further forward and tries to become the friend and the partner of the consumer as well?
As far as I'm concerned, I'm always focused on the end customer and what works for the customer eventually works. So wherever the consumer is happy to experience insurance, if it's on the platform, it would be foolish from my part to try to bring it back to me. I mean, if he's comfortable on your platform, he will experience the insurance around your platform. Then the question for me is more to think ahead. How can we work together to bring new features which will help them to better behave? Then after that, that features can also apply to my own customers or to the customer who will just use my services through your platform.
Just to follow up on that, Charles, and maybe I'll follow. So maybe on that point, let's say hypothetically one of these tech giants was going to come tomorrow and offer you to join their distribution platform, more like a price comparison or an aggregator. What would your sort of answer be to that proposition at a high level? And what sort of would your, if you were to join, what would your red lines be of participating, of sharing data?
I would try to take a higher level approach. I think that any investment, financial, timing, resources, partnering, needs to have a return of investment. There are some costs, some benefits. If you don't have a measurable ROI, just stop the partnership. Having said that, on the cost side, it can be a pay-per-play model, it can be an investment, it can be time, it can be securing market share, it can be many things, and on the benefits, effectively, it could be like accelerating your transformation, more mobilization, getting new business opportunities, securing market share, but it will be, I mean, an investment per investment analysis. And again, if you don't have a measurable and aligned ROI with your hierarchy and with the people in your organization, just don't do it.
I have a different opinion on that. I think the answer is really they won't share data. I mean, it's the reason the customer experience sucks when you have a quote comparison website, or even if it's on Amazon, is that once you get to the point of actually purchasing, you're clicking through to some other user experience, right? And that's because insurers hold on to their data very tightly, and they do not want to commoditize their products even further by having them side by side. So I don't think, if you look at an Amazon or an Apple or any of these giants, they're not going to get into this game to be a quote comparison site or anything like that. They're going to try to own as much of the vertical as possible. It might take some time to do that, but they're going to want to own the entire user experience. They're going to want the policies bound and issued on their platform themselves, and they're going to want a lot more control. So I would say, if you think Amazon, if they do enter the P&C game or anything like that, is going to do it as a quote comparison, I think that's definitely not going to be the case. I think they're going to try to own as much as possible. I mean, capital is a commodity, and capital is readily available both on the insurance side and on their own balance sheets. So they have plenty of money to put to work, and there's plenty of structures that they can put into place to actually retain some of this risk as well. So we talk a lot about the efficiencies on the customer acquisition side for these platforms, and those are true and those are compelling. But that's not why Amazon is who Amazon is today. It's not because they created this secret sauce to acquire customers to make the buying experience, buying books, that much simpler and easy. It's because they created this insane efficiency process on the back end, where they reinvented the supply chain. They are at their core a logistics company. So we focus a lot on tech giants entering the industry only on how they improve the user experience and the ability to acquire customers, but they will also innovate on the efficiency side, the back end, and they'll do it better. And that's something that should be a little bit more concerning for the quote-unquote incumbent in this industry.
And I don't disagree with you. I'm just saying that you need to be very clear on what you have to gain and what you have to lose. I mean, if for some reason, I mean, of course, it seems that you are looking at Amazon as a key one, but there are all the rest of the platforms, and they will have different approaches. Some of them will see insurance as a business line, otherwise as a strategic rationale to build trust, and there will be different approaches. Now, when it comes to massive aggregators, effectively, obviously we will be squeezed on margins, and obviously they will try to take a larger piece of the value chain. But here, your ROI becomes, okay, so if there is a one-third shift of the market from comparators to another type of comparators, marketplace, etc., am I going to do that? Or do we